this video is going to change your life. I'll be talking about the popular CRT model and how you can master and trade it the right way. So the main reason why I am making this video is to generally debunk the general belief people have about this CRT model. You know, a lot of traders focus on the CRT model more like a pattern or maybe one holy grail that is just newly found in the market. So I want to make it known that the concept you guys know as CRT has been existing normally before now as the normal price delivery algorithm. So it's already existing. But of course, I commend the creator of the model, which is CRT, because it also makes the job easier and also makes it easier to teach it also to other people as well. So first thing is, for those that are coming across CRT for the first time, you need to understand what CRT is all about and of course how you can use it to your advantage. So let's talk about the CRT model here. So in this video, I'll be talking about the CRT model, how to identify it on the chart, the common mistakes made by traders, trading with CRT, and also the right approach, which is the PAC way. Okay, so let's get into it. First thing is the method and the general way to identify the CRT model is that first, let's take this third candle out of it. Now, this is how it works. Anytime you see a certain range of candle and you see a turtle soup above this candle, let's say price is not closing above this candle range, the range of this bullish candle, you can see that the second candle here is not closing above it, which is a turtle soup, what we call a stop on Tabi. Now, the third movement we expect is for price to displace down to the low, which is a draw on liquidity over here. So the model is that simple. Okay, it's just a model of where to target and where price is expected to trade towards, which we call the draw on liquidity. So if price should take the range high over here, we expect the candle range low, which is the CRL here, to be the target for price to deliver to. And for the bullish type as well, when price also takes out the low, which is a turtle soup below the low over here, we also expect that price is going to trade to the candle range high. Okay, this candle here is the main range. So if the range low is taken out as a stop on, the next draw on liquidity is towards the range high. So this is the model that the CRT is built on. Now, I will also go further to explain that the CRT model is popularly known to be in this format, the three candle format, but then it can also appear in any of this format. Okay, so we could also have the CRT model in any of this form. Okay, this is like the two candle formation or model. You can see it's just two candles. Even over here also, we see price displacing the high, which is taking out the high over here, or what we call a stop on or a range. And of course, price going to displace the low right here. Okay, so and over here we have the multiple candles whereby it's the same model and concept is still being repeated. Price has taken the candle range high over here. We know that it must deliver to the candle range low. So it can decide to do that with a single candle like this, or it can do that with multiple candles. But then what matters is that price must trade to the low of the range. And we have the inside bar candle CRT as well. So in this one, it doesn't matter if it is a second candle. Okay, it doesn't matter if it is a second candle or the third candle that is picking out the range high or low. You understand? So over here too, you can see this is the range and this is inside bar. So a range is more like a move, like when you have a high, like an impulse move like this. Okay, this low over here to this high is a range. So what you see here now is the impulse move to the high. So of course, when price makes a pullback, which is a retracement down like this, eventually it can go back all the way up, maybe like this to the high. So it does not really matter if it is a second candle or the third candle that is taking out the candle range high. So the next target also is towards the low. So you see me using the magnet tool here. So the magnet is to indicate the draw on liquidity, the place we are expecting price to go to next. Okay, so this is basically what the CRT model is all about. But then I want you to now understand this with meaning. But before I even go further, let me go and identify this on the chart. Let me show you some ways to identify this on the chart. So over here, let's look at the recent one that happened. This is the one that happened recently. You can see this is the candle range here. Price takes the low of this particular candle range. So we expect price to trade to this high. So for that particular day, the bullish bias is going to be the thing we trade for that day. Okay, so this is one of the things you can, one of the ways you can use in getting your directional bias or daily bias. As a day trader, you want to know, are we buying today or are we selling today? That's exactly what every trader wants to know. In fact, if anybody tells us what the direction of the day can be, I'm very sure every day trader will be profitable now. So there are methods of getting the daily bias, and this is like one easy way, very, very easy way of spotting your daily bias. Over here, you can see something similar here too. This is like the inside bar. Can you see? This is exactly the inside bar. This is a candle range high over here, and this is a candle range low over here. So I'm referencing this particular candle in between here. So this is the moment price went ahead to raid the low. So where will be the target? It's going to go for the range high over here. So you can see after taking out the low, the next move was a buy towards that directional buy, so towards that draw on liquidity. So this is basically what the candlestick, the candle range theory is talking about. Okay, this is clearly what it's talking about. Look at this also, clearing the high, trading for the low. This is another example here, clearing the high of this long bullish candle, and then of course price trading to the low over here also. And this is another example we have here, clearing the low of the candle. The target is going to be to the high of that candle. So this is just a mode. You can see how it has been playing out, right? Now I'm trying to clarify this. Okay, I think it's on that inside bar. This is on that inside bar. Can you see? This is the candle range itself. This is a major candle we have here. Okay, let me change my candlestick color so it makes it make sense. When you're having the same color, you might not get what I'm saying. Look at this bullish candle we are looking at here. Do you see that bullish candle over here? This long bullish candle here. So all these ones are the inside bars. Okay, they are all inside the range. So over here, price eventually went to take out the low of the range, which is a liquidity hunt or a turtle soup below the low, right? And of course, the next draw on liquidity will be towards the high, which you can see over here. So you can use this you can combine it in several ways to get your directional bias, because at the moment price has taken the low of this candle here, all you need to know is that price is going to deliver to the high. So there are several opportunities of buying, all knowing that what price is targeting this certain high for sure. Okay, so that's how the candle range theory works. I think we have another one here also, takes out the high. The low is definitely to be targeted and all that. So it's just a model that we can repeat over and over. But I will now clarify, or should I say, I will add some things to it that is going to make it even making more sense. Let me not go and blunder in my grammar. So it's going to make more sense with the things I'll be adding to it. Now, first thing is, I said something that the CRT model is just a new name that was given to a certain model that has been existing before. So now let's talk about the model that has been existing before, and let's see the similarity between what I will call the foundation and of course what the new one that we have now as CRT is. So over here I made it known that the price algorithm, there's a law that governs price delivery algorithm. Okay, so over here, look at this. So price delivery algorithm simply states how price is being delivered. Okay, the mechanism with which price is being delivered. Okay, market doesn't just move randomly. We have made this clear. The market doesn't just move randomly. So I've explained in one of my recent video on YouTube here that markets, one of the methods of algorithm movement is, we have the external to internal, internal back to external, and external to external. So this is another method or another one that we have right here. Okay, this is another one we have right here. So what is the law saying? The law says when price rates a buy side liquidity, it targets the opposing sell side liquidity of the same type. Now this type is also important. So what I'm saying is, first thing is, what or where can we find a buy side liquidity? Above a swing high. Okay, the simplest way you can find, or simplest place to find that buy side liquidity is above a swing high. Okay, this is it here. Okay, we can find buy side above a swing high, and we can find sell side below a swing low. Okay, it's just like, it's a rule that has been set and it's clear and well defined. We know this already. So buy side liquidity rests at the high, sell side liquidity rests at the lows. So if you refer back to the law, it says when price rates, now what do we understand about trade? So over here, when we have this particular candle range high here, this highest point we have for this candle is a swing point. Okay, let's take this candle now as because again, this is another thing that we'll talk about of the same type. Okay, I mentioned this also when the buy side of the same type is being taken. So that will take us to another topic, which is types of liquidity. Okay, so under this type of liquidity, you learn about we have three major types of liquidities, just so you know. We have the major, okay, when I say major type, we have three main types of liquidity. Let me use that. So we have the major liquidity, the medium, and the minor liquidity. So for the purpose of this topic, we are focusing only on major liquidity. So major liquidities are the ones you have here. So when we talk about major liquidity, your previous yearly high or low, a previous monthly high or low, a previous week high or low, or a previous day high or low. They are all areas of what major liquidities. At least the example I showed you here on Euro USD, this is on the daily time frame, and the highs and lows we are referencing here, they are all daily highs and daily lows. You know, it's a daily time frame now, so that tells you that what the liquidity that is being swept under each of these places, they are major liquidities. Okay, over here you can see when price was taking out the high of this particular candle range, that's what a previous day high, and of course it's targeting the previous day low. Now that is where this particular rule is actually applicable. It says that if price takes a buy side, it targets a sell side. Now look at this. Let's take this first candle now as a case study. A particular candle, let's say this candle now is on the daily time frame. So if this bullish candle is representing a full daily candle, that means the highest point we have here, you guys know about the anatomy of a bullish candlestick, right? Okay, the anatomy of a bullish candlestick. So a bullish candlestick has this as a body and this as a high and low. Okay, we have this area here as our high, isn't it? This is the high, and this is a low over here. Okay, so this is the high of the candle, this is the low, of course the open and the close at the top over here. So now if I have this highest point that we are looking at here of this bullish candle, that highest point obviously is a swing point on lower time frame, because the highest point of a day is a swing point, right? And we have agreed that the type of liquidity vesting there is a major one. So let's say this is a major high, a major liquidity point. Now the second candle that you are seeing here, okay, what happened to this? It now went ahead to raid the high of the previous day. So let me do it in a much defined way now. Let me define it better for you. So it's more like having something like this, a bullish candle, right? More like having this kind of move as a bullish candle. Okay, we have this to be the low of the day, and we have this to be the high of the day, and price drop. So here has formed the swing high already. Okay, this high here has already formed the swing high, where we say that we have buy side liquidity resting above it. So if the second day, which is the second candle you are seeing here now went ahead to do a total soup above that previous high. Now in this case, we are going to say that what price has taken a buy side liquidity. Now look at the rule, which is why I said the CRT model is good, but it is actually reflecting a model that has been existing before now. So it's not a new name or a newfound golden strategy. Okay, so this old one is even something you can rely on much better than just even this newly found model. So let's take a look at it now. You just learn. Over here, price has taken a buy side, and according to the law, price must target the opposing sell side of the same type. Now over here we have a sell side here, right? But the sell side here might not be a daily low, because this time around the buy side liquidity that was rated, that means where we have our total soup here, the buy side that was rated here is a previous daily high, which means when price is now drawn towards another type of liquidity, it must be towards the same type of liquidity, which is a sell side liquidity of the same type, which is price taking a buy side, which is a previous daily high. It must target a previous daily low. Now if you look at that in comparison to this model, it's the same thing. They are both saying the same thing, but of course in different language. So now that's another thing for you to note. When you are trading your candle range high, your candle range theory and whatever, the candlestick you are referencing, the type of candle or the type of liquidity that is being taken, there really matters a lot. So, and I've showed you the types of liquidity that we have. We have the weekly, the previous yearly high, monthly high or low, weekly high or low, you know, whatever it might be. These are the major type of liquidities, and I will show you how you can use all these major types of liquidity to frame a bigger setup for yourself. Because obviously that's why we are here now. How can we use this as a trading system, not just as a trading model or a trading strategy alone? A full trading system. Okay, a full trading system is something that is complete. There's nothing left behind. Your directions are being defined, Your entry is also being defined. Your exit is also being defined. That is a complete system. Do you understand? So let's go into that. Now, when I say do you understand, I'm used to taking live classes, so I believe you guys understand and you are following me. So over to the audience. Now let's proceed to the next. And okay, now the next thing I think I was going to show you is the common mistakes, because I let me not talk too much and just go straight to the point. The common mistakes traders make with CRT model. Now, all of these are good and fine, of course, taking out the eyes and this, but then there's something you must learn, and that thing is, how do you position this model to work best for yourself? Like, to work best, like in what condition would this particular thing work best? Now, the CRT model is a price delivery mechanism, not a pattern. Okay, so that means when you go to the chart to deliver or to check out this thing, don't start looking for it in terms of a pattern. Like when I was checking out for it on the chart here, I was checking out for it in terms of pattern. Okay, but then if I was going to trade it, there should be a context for trading it, not just trading it out of the fact that price is not closing below this point or whatever, then I'm going to just follow it blindly. Okay, it must be traded within a context. Okay, and yes, it works best for reversals and not continuations. So in most cases, when you are trading this your key level or this your CRT, there's one thing that should be advised to you to be added to it. Make sure that particular CRT level is mitigating a key level. That CRT is actually forming off a key level. Okay, it's important for this particular one to be added. Okay, this clause needs to be added. Make sure it is respecting a key level. Okay, so that means there's a key level here and you find your CRT model playing out there or forming there. Yes, you can go for it. Do you understand? I think I have an example of that on BTC. Okay, I saw an example of that on BTC. Where are you, BTC? Where are you, BTC? Now, can you see this? This is a key level here, a major liquidity. And can you see the CRT model over here? So, and this is a major buy-side liquidity, right? So, price hitting that major buy-side liquidity and forming the CRT model here. That's a confirmation that yes, a reversal is truly going to happen. So with this context now, I can look for sales to confirm my reversals all the way down. Do you understand? But if I just spot this anywhere or in between the charts and I'm thinking it as it's going to reverse, then that would be so stupid of me. Hey, let me use that word. So stupid of me to trade. Okay, look at this instance here now. Look at this. Can you see that price is not close above this high? So why didn't we say that price must definitely go to the low here? Do you get that? Means it is not going to work in every case. So you're not going to just directly just go and start looking for this thing blindly. Okay, use this with the context. There must be something that what defines that, okay, price wants to reverse from this key level and I see the CRT, then surely it's going to reverse. I use that as a confirmation and I go for it. Do you understand? So that's one about the CRT model. Okay, there must be an objective for it. Okay, it must be used at key levels and not just anywhere. Can you see that? Now, it is advised to use on the higher time frame as a means to determine the directional bias. Okay, so on this BTC over here now, if I was going to take sales, I had opportunity of selling for 2 days. What are the 2 days? From the moment I saw the CRTs forming here, so this particular day I would have gotten a sell. This second day I would have gotten a sell until the CRT low, which is the low of the range, is being mitigated or being price gets to the target over here. Do you get? Can you see? This is a CRL now, the candle range low. This is a candle range high over here. So it's just a simple approach that can give you trading opportunities. Okay, so that's by the way. Then moving on to the next thing, it can be used for entry at POI or on a MTF or LTF. So let me take it slowly and calmly now. Now, MTF means medium time frame for me, and LTF popularly is a lower time frame. So even when you see this hitting your POI on a lower time frame, like a time frame you want to enter, and you see a CRT model there, you could just join from the next candle open to trade in that direction of your reversal. Do you understand? So it's a thing that can, it can be used in different ways, but the particular way, me myself, you can see that is not the main focus of this video. I only mentioned that, but the particular way I want to show you is how you can use this guy here to get directional bias, and also how you can trade it profitably. So that is those are the things I want to show in this video. So far I've been able to explain all of this, and okay, common mistakes made with CRT. Now, major traders, like I said, they trade it with just pattern. So I think I've already made that clear. Do not trade it as a pattern. Also trade it at key level. So I believe I've made that clear also. Now let's talk about the final way to now trade with CRT. Okay, of course, CRT or my own defined algorithm movement, whatever. So let's talk about the proper way to now use it. Okay, let's talk about the proper way to now use. So I designed this guy over here at the top, and is actually meant to pass a message. Okay, it's meant to pass a message. Now, I have different methods, to be honest. I have different methods I use in different trading systems. Let me use the word. I have different trading systems. And of course, trading systems are like they are the things that you need to form. Nobody can become successful by just learning entry pattern. If your strategy is defined in terms of pattern, when you see other block, you now buy from the other block, if fair value gap is present. If that is your trading strategy, like you always rely on only, you cannot go far. I'm sorry to say, but you cannot be profitable consistently like that. Do you get? There must be something that tells you of direction. So that is exactly where I'm going to. There must be something that tells you of direction. Now over here, this is one of the model or system I use. Now in this system, it takes note of 3 things that are highly important for every trader to know: liquidity concepts, market structure, and time and price. Now I will tell you where or how to apply each of these concepts. First one is liquidity. Now when you learn liquidity, for those that have learned about liquidity, buy side, sell side, now under it here, all you need to do is liquidity here is what gives us our directional bias. Okay, this particular model you are seeing here, I have under one that I will show you, that I teach as I will say directional bias, then your entry model, then your VIX, and all of those confirmation or whatever. So there's another model that I use for that one, but this particular one is quite defined. So under liquidity, you're not doing too much. All you need to do with liquidity is first identify a stop hunt. So now if I want to trade now, this is a system, this is a flow of what I call the system. So now what you need to do is, with this liquidity, identify the stop hunt and identify the draw on liquidity. Now that's those 2 things here that liquidity will do for you is why we have created the CRT model. Okay, now look at this. The stop hunt is the first, and this is exactly what we call the stop hunt here, right? This turtle soup move here, that's the stop hunt. Now after the stop hunt, the second thing is DOL, that is draw on liquidity. So if I want to, I'll like this link also. This is our DOL here. This is the highlighted area, our draw on liquidity, which means our target where I place my magnet. Do you understand? So now, first thing is liquidity helps me to know where there has been a raid, which is a sweep of liquidity. In this case, price has swept the buy side, and it must go for the sell side, still aligning with what the CRT model has said. Okay, so now if price is going to this level, can you see directional bias has already been figured out with our first approach here. Liquidity has already given us direction. Now market structure is now like our I want to have a name for this thing. I'm very sure I'll create a name for it very soon, but it's like I would say the vehicle. Now if this eye, let me just highlight something now. If I have this particular eye now as a buy side liquidity, and I have this low here as sell side liquidity, so let's take it that price traded all the way from the sell side here to the buy side over here. I want to just show you guys something real quick here, right? So let's take it that price traded from the sell side here to go to the buy side, and of course we've had a sweep of the buy side, which is a stop hunt of the buy side, and we know now that price is going to the draw on liquidity, which is the sell side. Now mostly what you need to know, that is where the second stage comes in. Price will not just fly in one single straight line. Of course, you are seen as a single candle on the monthly, the weekly, the daily time frame, those higher time frames where you spot your CRT. You are all seen as a single candle. But don't you know that on the lower time frame, for price to move from this area of the rate of the stop hunt to go to the area of the target, which is the draw on liquidity, what do you think must be done? Price will follow an order flow, which is a structure. Okay, so this is exactly the framework I want to show you guys now. When you spot your CRT and you know price is going to your CRT low, right? Go now to a lower time frame, a much lower time frame. As long as the structure there is clear, the order flow there is clear, that is exactly where you have the chance to strike. And when I mean strike, that is where you have the opportunity to get in on different opportunities or entries towards your direction, which is your target. Okay, now I believe that is clear also, and I'll give you maybe examples on the chart, real life examples. Now, Q zones is the final one, of course, still helping you in the entry. Okay, so the Q zone here is when you now take the entries. Obviously we want to get in on sales from here. Of course, all sales towards the draw on liquidity, which is our main target. So the Q zone are areas where we can get those opportunities. Now, I don't fully depend on Q zones, but of course, this last part is where we have the confirmation. For example, now, if I was having this as a monthly range, for example, if it's a monthly range thing, one of the things that Q zones can help me with, or timing can help me with, is if it's a weekly range now, I can be able to tell which day of the week are we going to have reversals. So in case you have not studied it, we mostly have midweek reversals on Tuesdays and Thursdays. Okay, markets can set the previous or initial high of the week on Tuesday, and there will be a total soup of it on Wednesday. So these are things you need to know. Midweek reversals are real. Price reverses midweek, maybe on Wednesdays or Tuesdays, and sometimes on Thursdays. Okay, but the one I favor mostly is Tuesdays and Thursdays. Okay, those are the times you can have the market forming the high of the week or the low of the week. So this kind of thing, this kind of knowledge also can be combined on the lower or on your time frame here towards your direction. Okay, it's like having confluence. Okay, having confluence is what to give you that precision you need, or the entry you need towards your direction, and of course your entry confirmation. So these are all, this is the framework I'm talking about. Let your CRT give you show you the stop on, which is the I being taken, and of course the DOL, which is the draw on liquidity. How you now enter is following the order flow of the lower time frame, not that particular candle's flow on that time frame. Okay, so I love to use AUDCAD because there was a particular trade of a particular year that gave so much clarity. Now, what was the trade all about? Let me show you guys here on AUDCAD. So I will use a chart that is already existing, and I want to keep this video short as possible. So maybe in my next upcoming video, I will now show more examples so that this video is not too long for you to grab all the information I intend to share or that I've shared in the video. So over here, this is AUDCAD. I'm sorry, I'll have to take this back to my black and black. This green is shouting on me. It's been a blessing. So now look at this. This is the highest point of the year 2022. Now, when price went over to that year, look at though, if you are looking at this thing now in terms of candle, the candle will look like, very, very closely to each other now. This is like a year 2022, a second year 2023. So when you place the candles together, what do you think you're going to get? You're going to get that candle range now, the whole candlestick range and all that. Now, the second year, price went to take out the high of the previous year. Can you see? This is price trading to the buy side, which is the previous year high, and taking it out. Now, according to the rule I gave you earlier, if price makes a buy side, it must go for a sell side of the same type, which is a previous year high has just been taken. Price not going to target a previous month low. Look at this low you have here. This particular low here is the low of a particular month. So will price be targeting that low now as the draw on liquidity? No. A yearly high has just been raided. So the CRT model is the same thing, right? If price takes out the range, like look, in this case now, this is our range. The high here the high here to the low here is our range. And now price has traded all the way now to take out the range high. So where must it go to? It must go to the candle range low, which in this case is the previous year low. Now, that is where that thing I mentioned, which is the order flow. So once you identify the target, the stop on, this is stop on over here, and you have identified the draw on liquidity. Those are the two things that liquidity will do for you. The second thing is order flow. Price will not just fly from here and go down in a single line. I mentioned that. It's going to follow a particular flow. And that order flow is where your chance of making entry is being presented. Okay, can you see now? Different opportunities of entry will be presented to you now along the way to the target. So we have different high. This is the high, a high, price reading. In fact, on this particular one, you can see this is the highest point of the month. The price went to the previous month high. rates out the previous month high and still drops again, all because it's going to much more major target, which is a yearly low. Okay, because in terms of liquidity, the higher the time frame, the higher the degree or the strength of the liquidity also. So over here, price takes a buy side of a previous month high, it must go to the previous month low, and that is all being delivered. So you have all these entries over here. You can see all these entries over here until price eventually gets to the final target we have over here. Okay, so this is exactly the framework you can apply. It can work on the yearly, on monthly, on daily, on weekly. So but mostly if you apply this on a weekly range also, it makes more sense, because you can get to catch more opportunities within the week and all that. So this is just one of the models you can use in getting your directional bias. So I almost forgot to add this. Now there's also another rule in CRT that states like this, that when you see price reading the high, it is not all the time. There's another level of the CRT, which is the 50% of the range. So according to the CRT traders, they also believe that price can also trade into 50% of their range. So for example, let me use this. If this is my range now. So these guys also believe that price can trade into the 50%, which is the midway of their range, and then buy from there. So for that particular law, what they believe is that price can trade like this into the 50% level here, and then continue buying from there to go higher. Now I will clarify this particular rule also, because I want you guys to have the actual knowledge about these things. Fine, the 50% level that is being rejected here to make price start going up, it is working on a different principle. Okay, there's a different concept that teaches about price trading into this level and then continuing from there. Remember, I told you that the CRT model works mostly or works best in reversals. Now there are other contexts whereby the market needs to continue, okay, whereby the market is not ready for reversal, or we are not having a reversal. So when you understand that, okay, the market is drawing towards maybe a higher liquidity here now, and you currently see this pattern whereby you know that the market is not expected to reverse now. We expect this guy to trade actually up the way to this high here. So we don't expect to have a reversal yet. Then you can be looking at something like this. Now, if we have this kind of thing, if you have something like this in the market, whereby you have this as your fair value gap, this is exactly when you have your internal range liquidity. Remember, this is the fair value gap, the immediate fair value gap that we have here, known to be internal range liquidity. So price could be going from the external range over here to trade into your internal range, which is a 50% area here, and from there reject to go back up, all the way back up like this to this external range, and of course ultimately get to your target. But because most of you only learn this in terms of pattern, once you just see this candle, your everything just changes. Like all you just think of is that it must surely go to the low, it must go to low by 5 by 4. So this is another way you should know how to use it well. Okay, so it is not all the time price targets the candle range low. Okay, price can also get into internal range like this. Okay, these are the things or the cases whereby price will not get to your target and will just get into maybe halfway into the range and reverse. Okay, so it is important to add this also so that you know when to expect a full reversal to the candle range low, just like in this case, or when price can turn from halfway to continue going higher. Okay, the previous video I talked about internal range to external range, this and this. So we have quite a number of them, and this is just like few out of the things that I teach in the PAC mentorship. Okay, so guys, I'm sure this video has really helped you guys a lot, and I'm sure you've gained something much valuable in this video than you've ever gained in any other video you've watched on YouTube. So if you love this video, make sure you subscribe to the channel, share this video to anybody, like anybody that just come across, just tell them that you found a particular gold mine and you don't want them to miss it also. Make sure you are sharing the YouTube link, make sure you are spreading the gospel about PAC, okay? Because I'm here to give you guys real undiluted truth about the market, things that will truly help you and not work against you. Okay, so we are going to talk about all of that, and like I said, I'll dedicate another video. That other video will be dedicated to now making all of this theory into the practical mode. So I'll be giving you the live practical and of course the live examples. But then how I will know you guys want that video is by your engagement on this particular one. If you guys engage fully on this one, trust me, I'll be making more and much more of these videos on CRT model. Okay, so you can see it's not a bad model. You just need to apply it the right way, and of course complete your system. Okay, so this is what makes this system complete. The CRT model majorly is this one you have here, the liquidity stock onto DOL. That's majorly what it defines. But now we've gone further to define how you can also enter the trade or catch your own opportunity towards the target, of course the low that we have here. Okay, so yes, you can see price reading the previous high, targeting the low. It's not going to just go there in a single line on lower time frame. Several moves will be presented to us, so that move is where you can position yourself to get yourselves to the target, which is our DOL. So I hope with this video I've been able to show you guys how you can apply the CRT model the right way, and also how you can combine this into a full trading system. So if this video helped you, make sure you engage on it and share with your friends. Thank you very much for joining or for watching the video, and I'll see you guys on the next one.